Profiting from a weak US dollar sounds amazing, right? After strong and steady gains through the late 2010s, the value of the dollar relative to other world currencies has been gradually weakening since 2020. The depreciation accelerated into 2022 as inflation has picked up, impacting both domestic and international investments. When the dollar is strong, it reflects a robust US economy, low Federal Reserve interest rates increases, and tax policies that encourage companies to bring back profits from abroad. 2. On the other hand, a weak dollar can signal an economic downturn, rising inflation, or both. The impact of the rise or fall of the US dollar on investments is multifaceted. Most notably, investors need to understand the effect that exchange rates can have on financial statements, how this relates to where goods are sold and produced, and the impact of raw material inflation. So, welcome to MoneyIQ. Before we continue, please take a brief moment, go down and smash the like button, and if you have not subscribed to our channel yet, what are you waiting for? Please do it. The confluence of these factors can help investors determine where and how to allocate investment funds. Read on to learn how to invest when the US dollar is weak. Domestic impact. In the US, the Financial Accounting Standards Board, FASB, is the governing body that mandates how companies account for business operations on financial statements. 3. The FASB has determined that the primary currency in which each entity conducts its business is referred to as functional currency. However, the functional currency may differ from the reporting currency. In these cases, translation adjustments may result in gains or losses, which are generally included when calculating net income for that period. What are the implications of these adjustments when investing in the United States in a falling dollar environment? If you invest in a company that does the majority of its business in the United States and is domiciled in the United States, the functional and reporting currency will be the US dollar. If the company has a subsidiary in Europe, its functional currency will be the euro. So, when the company translates the subsidiary's result to the reporting currency, the US dollar, the dollar or euro exchange rate must be used. 4. For example, in a falling dollar environment, 1 euro buys $1.54 compared to a prior rate of $1.35. Therefore, as you translate the subsidiary's result into the falling US dollar environment, the company benefits from this translation gain with higher net income. Why geography matters. Understanding the accounting treatment for foreign subsidiaries is the first step to determining how to take advantage of currency movements. The next step is capturing the arbitrage between where goods are sold and where goods are made. As the United States has moved toward becoming a service economy and away from a manufacturing economy, low-cost provider countries have captured those manufacturing dollars. 5. US companies took this to heart and began outsourcing much of their manufacturing and even some service jobs to low-cost provider countries to exploit cheaper costs and improve margins. During times of US dollar strength, low-cost provider countries produce goods cheaply. Companies sell these goods at higher prices to consumers abroad to make a sufficient margin. But when the dollar is weak, it helps exporters. As the US dollar falls, expenditures are paid in US dollars, but revenues are received in stronger currencies. In other words, becoming an exporter is more beneficial to a US company. Between 2005 and 2008, for example, US companies took advantage of the depreciating US dollar and US exports showed strong growth, shrinking the US current account deficit to just 2.744% of gross domestic product, or GDP, in 2009. However, many of the low-cost provider countries produce goods that are unaffected by US dollar movements because these countries peg their currencies to the dollar. In other words, they let their currencies fluctuate in tandem with the fluctuations of the US dollar, preserving the relationship between the two. Regardless of whether goods are produced in the United States or by a country that links its currency to the United States, in a falling US dollar environment, costs decline, profiting from the falling dollar. Taking advantage of currency moves in the short term can be as simple as investing in the currency you believe will show the greatest strength against the US dollar during your investment timeframe. You can invest directly in the currency baskets, or exchange traded funds, or ETFs. For a longer-term strategy, investing in the stock market indexes of countries you believe will have appreciating currencies, or investing in sovereign wealth funds, which are vehicles through which governments trade currencies, and it can provide exposure to strengthening currencies. You can also profit from a falling dollar by investing in foreign companies or US companies that derive the majority of their revenues from outside the United States, and of even greater benefit, those with costs in US dollars or that are US dollar linked. As a non-US investor, buying assets in the United States, particularly tangible assets such as real estate, is extremely inexpensive during periods of falling dollar values. Because foreign currencies can buy more assets than the comparable US dollar can buy in the United States, foreigners have a purchasing power advantage. Finally, investors can profit from a falling US dollar through the purchase of commodities or companies that support or participate in commodity exploration, production, or transportation. So guys, that's all for today. Did we miss anything? Please let us know in the comments. Do share this video with your friends, and don't forget to subscribe to our channel for more informative videos. See you next time.